keep hearing about IFRS, US GAAP, and the differences in accounting. In reading 24 of the CFA curriculum that deals with financial reporting standards, we will get some insight as to what these various guidelines are and how they are decided. So we'll start with the introduction and importance of accounting guidelines, standard setting bodies and regulators, how far have we reached on global convergence. We'll understand IFRS reporting and the differences between IFRS and US GAAP, and wind up by understanding the elements of a coherent reporting framework. As discussed earlier, the objective of financial reporting is to provide information about the firm to current and potential investors, creditors, that is useful for making a variety of decisions. Now, these investors and creditors can come from various geographies and have differing profiles. Hence, we need reporting standards that ensure that transactions are reported by firms similarly. So, a firm operating out of the US or a firm operating out of the Philippines should create their income statements and balance sheets in a similar format and using similar guidelines so that an investor sitting in China is also able to understand and comprehend these statements and decide where to invest or not. So standards ensure that a wide base of potential investors and creditors can use the information and enhance comparability across companies. Standards must, however, remain flexible and allow acceptable discretion so that the economics of all transactions can be properly reported and fairly presented to the users. These guidelines are given by standard setting bodies that are professional organizations of accountants and auditors who establish the financial reporting standards. Within the US, the body is called Financial Accounting Standards Board, and the accounting guidelines are referred to as Generally Accepted Accounting Principles, also known as US GAAP. The international standard setting body is referred to as International Accounting Standards Board, IASB, and the principles and the accounting guidelines are referred to as International Financial Reporting Standards, or IFRS. Some of the older IASB standards are also known as simply International Accounting Standards, that is IAS. Many other countries in the world have their own national standard setting bodies, and a lot of them are now working towards convergence with the IFRS, including US, as we'll see. So what are the desirable attributes of standard setters? They should observe high professional standards, have adequate authority, resources, and competencies, have clear and consistent standard setting processes, guided by a well-articulated framework that we should soon see for the IASB, operate independently, should not be compromised by the industry or by special interests, and decisions should be made in the general public interest. So standard setting bodies recommend and establish the accounting guidelines, whereas the regulatory authorities have the legal authority to enforce compliance with the financial reporting standards. Various regulatory authorities exist. For example, in the US, the Securities and Exchange Commission, also known as the SEC, decide the filing requirements for publicly traded companies. We'll see an example of some of these filings in the coming slide. These filings ensure that all investors receive material information about various listed corporates at the same time and promote fairness and transparency. The filings also ensure good corporate governance and are arguably the most important source of information for the analysis of publicly traded firms. The three main objectives of financial market regulation are: first, to protect investors, ensure fairness, efficiency, and transparency in the markets, and thereby reduce systemic risk. So regulators in various countries have often seen to penalize and fine corporates who do not conform with the reporting standards or the filing requirements. So just for example, the SEC in the US requires listed companies to submit the following filings. Please note you do not have to remember each of these, but just browse through them to get a sense of all the information that listed corporates need to disclose from time to time. Form S1 is filed prior to the issuance of new stock. Form 10K provides information about the annual operations of the firm. 10Q provides similar details on a quarterly basis. If there's a matter that requires shareholder vote, then the company needs to prepare a proxy statement detailing the elements and other aspects of the issue. These need to be filed with SEC as Form DEF 14A. Similarly, other disclosures ensure that investors are aware and updated with all necessary information. As far as the convergence between national accounting standards and IFRS is concerned, European Union requires IFRS financial reporting by all publicly listed companies. Efforts to align are ongoing in the US, Japan, China, and many other countries. Various barriers to convergence exist. For example, different standard setting bodies often disagree on the best treatment of a particular item or issue. The US GAAP, for example, allows the LIFO method for inventory accounting, whereas IFRS does not allow LIFO and only works with FIFO and weighted average cost methods, as we'll see. And barriers also come from political pressures, from business groups, and others who will get affected by the changes in an adverse manner. We'll now move on to understanding the conceptual framework of the International Accounting Standards Board. So, ISB requires two qualitative characteristics. First, information should be relevant, that is, it should have some economic significance. That is, it must give us some help in predicting the future performance or position of the business, or it should have confirmatory value, that is, it confirms prior expectations of the transactions that were expected to happen. Relevance also implies materiality, that is, any information or transaction that can affect the stock price or valuation, or has other material impact like affecting the profitability or growth in the business, must be recorded and presented. Information should be faithfully represented, that is, it is complete, unbiased, and free from error. No transactions have been missed out, and care has been taken to fairly report all aspects. The qualitative characteristics are enhanced if the information is comparable, that is, across time the company follows similar methods of reporting. It is verifiable, that is, independent observers come to the same conclusion about the information. It is reported in a timely manner, and people with basic understanding of accounts are able to use and understand the statements. The ISB further requires that the following elements must always be reported: assets, liabilities, equities, income, and expenses. An item should be recorded if the economic benefit is probable and the cost can be reliably measured. The exact amount at which an item is recorded depends on the measurement base. The measurement base normally is the historical cost, that is the original cost of the asset. It can also be the amortized cost sometimes, that is the historical cost minus accumulated depreciation or amortization. Some elements are recorded at current cost, that is the amount that the firm would have to pay today to purchase the asset. The realizable value is the amount for which the firm could sell the asset. Present value is the discounted back value of the asset's expected cash flows. And sometimes items can also be recorded at fair value, that is, the amount at which two parties in an arm's length transaction would exchange the asset today. So IFRS requires the following financial statements to be presented from time to time, and these capture the elements that were presented in the previous slide. So balance sheet, statement of comprehensive income or the income statement, cash flow statement, change in owner's equity, and explanatory notes, including a summary of the accounting policies used. The general features or assumptions or guidelines that we are expected to follow when we are making these accounts are that, first of all information should be fairly presented. Accounts are made on a going concern basis. There is no immediate liquidation is expected, or the firm is expected to continue operations till the foreseeable future. Accrual basis, that is, transactions are recorded when they happen, not when cash is received or cash is spent out. There should be consistency between the periods in classification and accounting methods, and previous period statements should also be presented for comparability. Materiality implies that all material information should be fairly presented, and the statements should be free of any misstatements or omissions. Similar items should be aggregated, and dissimilar items should be separated to enhance understanding. Offsetting of assets against liabilities is usually not done. So assets should be reported separately, liabilities should be reported separately, unless a specific standard requires otherwise. All statements must at least be presented annually, and comparative information for prior periods should also be presented. So it's not always possible to present the minutest details and every small transaction in a detailed manner as we must ensure that the benefit that users gain from the information should be greater than the cost of presenting it. So for example, reporting each individual sales record is normally not a good idea because it may have some economic significance, but users do not gain much benefit out of it. Secondly, a lot of qualitative information about a company, its reputation, brand loyalty, creativity, etc., cannot be captured directly in numbers and in the financial statements. The two significant broad assumptions that we make while creating accounts is first that of accrual accounting, which, as we studied in the previous reading, implies that financial statements reflect transactions at the time they occur, not when the cash is received or paid. And second is that of a going concern that assumes that the firm will continue to exist for the foreseeable future. Now, IFRS and US GAAP are conceptually quite well aligned in my opinion. However, some differences do exist in specific guidelines and others in the semantics and definitions, as we'll just see. So the IFRS framework lists income and expenses as elements of the income statement, whereas the FASB framework includes revenues, expenses, gains, losses, and comprehensive income. The Financial Accounting Standards Board defines asset as a future economic benefit, whereas IASB defines it as a resource from which a future economic benefit is expected to flow. So no conceptual difference per se, just the way they define an asset is a little different. And as we will see further down in the curriculum, the FASB does not usually allow the upward valuation revision of most assets, while the IFRS does. In many countries, companies that are following the international financial reporting standards need to also provide a reconciliation statement reconciling the reported statements to US GAAP or to the National Accounting Standard. A coherent financial reporting framework, be it under IASB or FASB or any national accounting standard, should be transparent, comprehensive, and consistent. That is, disclosure should be full and fair. All types of transactions should be recorded, and similar transactions should be accounted similarly across firms or geographies. Now, barriers to creating a coherent financial reporting framework that has all these properties can stem from issues related to valuation, that is, should we carry elements at their historical cost or the fair value? And in many instances, we see that both are also allowed. So while historical cost is more objectively measured, fair value presents the true economic worth of the item. Should standard setting be principle based, as in the IFRS, wherein the broader guidelines and the accepted principles are recommended, but the standards are not very prescriptive, as against a rules-based approach that is seen more in the US GAAP, where standards more specifically prescribe the treatment of various items. So while a principles-based approach may be more comprehensive and may even promote transparency, it may result in some inconsistency amongst firms and geographies in the reporting and presentation. A rules-based approach, on the other hand, facilitates consistency that may come at the expense of comprehensiveness or transparency. An objectives-oriented approach blends the two approaches. Third set of barriers come from measurement that represents the trade-off between properly valuing the elements on the balance sheet and properly valuing the changes between points in time as in the income statement. So a lot of times, as we'll see in the curriculum, we need to remeasure, revalue, write off, write down assets and liabilities, and standards differ on whether they should be recorded in the income statement or they should be adjusted directly in the balance sheet. An asset liability based approach would focus more on balance sheet valuation and remeasurement, whereas the revenue expense based approach would require more changes to be recorded on the income statement. So accounting policies and estimates are often declared in the footnotes to financial statements. Significant policies are also addressed in the management's discussion and analysis in the annual report. And many times companies are required to disclose the impact of implementing a recently issued accounting standard, even though they may not have adopted the accounting standard yet. So that's about the review on financial reporting standards. But please make sure that you watch the video once again before the exam just to refresh concepts and guidelines.